Well, let's get started. This is Michael Morris, and let me welcome all of you from across the country. This is a part of our inaugural webinar series for the Center for Disability Inclusive Community Development. And we're really excited about today's webinar because it builds on our prior two webinars. This webinar today is focused on a discussion with bank regulators, and joining me in this discussion and will be part of the questions to the panel, who we will introduce in a few minutes, will be Mark Reichert, who is both the Director of Public Policy at National Disability Institute and is sharing responsibilities for directing our new Center for Disability Inclusive Community Development. But before we go forward, we've got some housekeeping logistical pieces to share with you, and I'm going to turn back to Katie, who will take those up, and then we will move on to the program itself. Katie?
Thanks, Michael. So we're just going to go through a quick couple of slides about some of the technical aspects for the webinar. Listening to the webinar. The audio for today's meeting can be accessed using computer audio or by calling in by phone. If you select computer audio, please make sure your speakers are turned on or your headphones are plugged in. If you do not have sound capabilities on your computer, or if you prefer to listen by phone, dial 1-929-205-6099 and enter the meeting code 632-483-895. Captioning. Real-time captioning is provided during this webinar. The captions can be found by clicking on the CC button in your Zoom controls at the bottom of the screen. If you do not see the captions after clicking the button, please alert the host via the chat box. You may also view captions in your browser at http://www.streamtext.net/event=NDI. Submitting questions. Please use the Q&A box to submit any questions that you have during the webinar, and we will direct them accordingly. If your question is not answered during the webinar, or you are listening by phone and not logged in, you may email the host at kauchenbach@ndi-inc.org. For technical assistance, if you experience any technical difficulties during the webinar, please use the chat box to send a message to the NDI host or email kauchenbach@ndi-inc.org. Please note, this webinar is being recorded and the materials will be placed on the National Disability Institute website under Resources, Webinars. And with that, I'm going to turn it back to Michael to introduce our panelists for today and get the conversation started.
Thanks, Katie. Very pleased today to share with all of us from across the country insights and information from our two panelists. Joining us today is Paul Ginger, Community Affairs Officer with the Office of Controller of the Currency, or OCC, and Jessica Farr, Manager of Examinations with the Federal Reserve Bank of Atlanta. Let me share with you a little bit of information about Paul. He's a District Community Affairs Officer with OCC. He works with national banks and federal savings associations, bank examiners, community development organizations, and others to encourage financial institutions to participate in safe, sound community development and reinvestment activities. His many years of experience includes underwriting small business and commercial real estate loans, designing and implementing community development loan programs, helping banks meet their obligations under CRA, the Community Reinvestment Act, and managing a public policy organizing campaign on economic development matters in Chicago's lower-income neighborhoods. Our second panelist is Jessica Farr. Jessica is with the Federal Reserve Bank of Atlanta, and she is a subject matter expert on the Federal Reserve Bank of Atlanta's Community Reinvestment Act CRA team. Jessica joined the CRA team in June 2011 and is primarily responsible for large bank CRA examinations. She is also currently working with the CRA Policy Division at the Federal Reserve Board of Governors, so at the federal, national level, on CRA modernization initiatives. Jessica's experience has been with banks, with nonprofit organizations, and government agencies on various community development activities, including affordable housing, financial stability, small business, job creation, and neighborhood stabilization. Previously, Jessica was an assistant vice president at Bank of America in Nashville in their Community Development Corporation, where she oversaw the single-family housing development program. So, again, for those of you, I hope, who may have joined us on either or both of the prior two webinars, in our first webinar back in July, we shared with you an overview and an introduction to this new center on disability inclusive community development. We shared with you why did we open this center, what the center intends to do, and how it hopes to be a bridge between the nonprofit community across the country with financial institutions, and for all of us to pay more attention and be more intentional in our collective work to create inclusive community development activities. In our second webinar, we were privileged to have Dory Rand with the Woodstock Institute in the Chicago area. Dory is a recognized national expert on CRA, and particularly helping community-based organizations understand how to get involved in the process, how to be engaged with financial institutions, and she shared with us many valuable insights, particularly for those of us in the disability community who may be new to CRA. What is all this about? Well, before I turn to Paul, and for him to give us his perspective, representing the Office of Controller of the Currency, I will share with you one number which sticks in my head from a recent meeting I had at OCC. And that number was that I believe some 2 years ago, maybe it's the last number known in terms of an aggregation of activity related to CRA by financial institutions nationwide, there was an expenditure of over $400 billion. $400 billion, whether that related to investment, to lending, to service activities. Now that's a collective number, not one bank, not one part of the country, but again, the aggregate level of effort for 1 year. I would expect that that number perhaps went up in 2018, or certainly remained steady, and now we're in 2019. I just leave all of us with one simple challenge, easier to say than perhaps accomplish, and that is that if simply 1% of that $400 billion was with forethought and informed decision-making led to support of low and moderate income individuals with disabilities, living in low and moderate income neighborhoods within banks' footprints across the country. We're speaking about a number that would approximate $4 billion. $4 billion would be larger than any public expenditure in any individual of many federally funded disability programs. So it's just a thought and something to puzzle over, to challenge us to think about. But with that, I am pleased to be able to turn to our first speaker, Paul, and have you describe for us, for our audience, as I see the numbers growing this afternoon, to provide some insights about banks and their communities, and turn it over to you now. Paul?
Well, thanks, Michael. Thank you for having me join this webinar. I'm going to go through a few high-level conceptual themes to begin with. And if you could switch to my first slide, please. I'm hoping that by going through some 60,000-foot level overview of the banking industry from a couple of different perspectives, I might give you, the people in our audience here, some means for finding a way to I'll say, lay claim to that 1% of the 400 billion that you were just talking about, Michael. And so the first one really it has to do with the economic functions that banks fulfill in our society. So one good way that I like to think about banks is that overall, they just help the economy function smoothly. They do this by conducting the activities that I've listed on this slide. Banks provide consumers and businesses a safe place to keep their excess cash, which from a banker's or a regulator's perspective is the gathering deposits bullet point here. I think from a community development perspective, I would include under this first bullet point bank involvement in financial education or in things like an individual development accounts program. I also might think about the requirements for having a bank account, a deposit account, or a transaction account, a checking account at a bank. These are requirements, of course, that vary from bank to bank. And, of course, you want to compare with the needs of your constituencies. Banks also help businesses and consumers manage fluctuations in their cash flows by issuing credit cards and providing other short-term types of credit that help us bridge the difference between the cash we have on hand at a given moment and the expenditures we face. Things, of course, like medical expenses or home or car repairs can disrupt the best laid plans of the most financially astute people. And short-term credit can help us get past those hiccups. So it's an important function that banks provide certainly for consumers and for businesses. Banks also help consumers make large expenditures that we just can't make out of our savings, things like buying a car or buying a house, and they do that, of course, by providing us loans for those purchases. Similarly, banks can help businesses maintain or expand their operations and increase their productive capacity, which often entails hiring more people. And they do that by providing loans for large expenditures that would outrun any business's savings or credit otherwise from vendors. Banks help consumers and businesses make and receive payments by processing credit cards and providing checking accounts and via debit cards, mobile phones, and things like that. Here, too, it's good, I think, to be cognizant of the different features, the costs, and other requirements of these accounts and services, and think about how well they comport with the needs of the folks that we're trying to serve, or that the audience here today is trying to serve. And of course, banks provide a variety of other services, such as renting safe deposit boxes, check cashing, and transferring money from one place to another. And they do all of these things with the intention of making a profit. That is that income will exceed expenses, which is, I think, an important point to keep in mind, and I think I'll lay that out in the next couple of slides a little more particularly. I wanted to go over this very simple scheme of the banking function, or the function of the banking industry, because these bullet points really, I think, outline the several realms in which you and your audience, Michael, will want to engage banks. For instance, what more can banks do in the realm of gathering deposits or in extending short-term credit that your constituencies would find helpful? If you can go to the next slide, please. When I think about bankers, I think of them in terms of a variety of motives that they have for developing partnerships with community development organizations, with nonprofits. Many bankers, in my experience, they do see a close connection between the health of their banks and the communities they serve. They need an economically vibrant community, a good place to live, in order to have a sound base for their business. And they're motivated by that close connection between their business self-interest and the well-being of their community. They're motivated by that close connection to seek partners that will help them ensure that their communities are economically vibrant. Bankers are also motivated by a number of narrower concerns too, and I've listed those on this slide, or at least some of them on this slide. Increasing their market share, for instance, their share of loans or of deposits or of customers for their other services. They'll always want to talk with people who can help them acquire new customers. Bankers also are motivated by their need for income. They need the interest they earn on loans and the fees they charge for their services to exceed their expenses in order for their institutions to remain viable in the long run. They'll want to talk with those who can help them reduce the costs of doing business by helping them prepare prospective borrowers, for instance, so that the application process can proceed smoothly and quickly. A significant portion of the banking business also entails the management of risk. So bankers are motivated by a desire to mitigate the risk of losses on loans, for example. So partnerships or programs that you can bring to the table that can increase the likelihood that a bank's loan will be repaid over time will be of great interest to them. And then I also find that bankers are motivated to uphold their reputations, that there's little more important to bankers than their reputation in the community as a business that deals fairly with all of its customers. And finally, very much related to reputation, bankers are motivated by CRA. And you might notice that I put that last on this list here. Even though there are very few exceptions to those bankers who everybody, I think every banker wants to do well on their next CRA exam, except for a couple that I've run into that could take it or leave it. But I wanted to put CRA in some broader perspective of the bank's overall group of motives for the various things they do, because I believe that you'll be more successful in developing a partnership with a bank if you engage them on several of these motives simultaneously rather than relying just on CRA. So if you could switch to the next slide, please. Now, here's the last conceptual scheme I gave you. So if I gave the banks, the role of banks overall in the economy and society, and then some scheme for thinking about the particulars of how banks think about the way they do business, this is a little different take on the way bankers do business. I've often had bankers say that they've had some difficulty seeing just where CRA fits in the regular course of their business, that is within the bounds of safety and soundness. And I use these circles here that I've got on this slide, the concentric circles of opportunity, as I call them. And I should say I have borrowed this from the Woodstock Institute from long ago when I spent some time on the staff there. And so I just should give some attribution to the people that I've taken these things from. So I want to think about that smallest circle in the middle there. When I talk with bankers about these things, I want to give them a dynamic market orientation that can help them to meet a number of aims at once. I want to help them think about expanding their loan market share, maybe warding off pressure from community advocates or even from us regulators, maybe improving their reputation in the community and improving the community at large, the place where they do business. So that first littlest circle is, I like to think of it in terms of that's the bank's current existing market share. It certainly is meeting credit needs in the local community. The next circle out from there is the bank's market share that might be available with a little extra effort, perhaps a little more aggressive marketing, maybe deliberately cultivating a reputation for working hard to approve loan requests, and other kinds of just small changes in what they do that might get them new customers and a greater market share. If you go out to the next circle beyond that, so I'm gradually expanding the bank's market share I'm trying conceptually to do that. I think of that third circle out as the market share that might be available despite transaction costs. These often will be smaller loans or loans with a couple of layers of financing, so they're not altogether straightforward. They take a little time to understand, or these might be loans that would fall between the cracks of standard loan policies. They're deals that with a little bit of extra time and effort and imagination, which comes at some cost to the bank, but they're safe and sound. And if the bank sets out to chase down those kinds of deals and to exercise that kind of patience and imagination, they may find themselves with additional good, safe and sound opportunities. And then I'm going to go out to the fourth ring. I don't know if I have that many here, but follow along with me, at least conceptually. This is a market share that might be available only with third-party participation, with organizations like the Small Business Administration or a guarantee from the USDA or from others that allows the bank to stretch its underwriting criteria, or that allows the bank to offer terms for the loan to value, for instance, or the loan maturity, to offer terms that wouldn't be available under strictly conventional norms. And then finally, the beyond those circles, I would say, perhaps, is the total realm of economic and financial needs altogether, let's say of low and moderate income communities. And a lot of times banks participate in that realm with their charitable giving, which can be connected to each one of those other market circles, by the way, and which I encourage banks to do when they write their charitable giving checks, to think in terms of ways they can support their usual lines of business. But bankers also can be leaders in influencing the charitable and the community-oriented activities and priorities of other businesses in the community, or of local government, or of community foundations and others. And I always encourage bankers to think about their significant role that they can play there. So I also, I should say, use these circles with nonprofits to suggest to them the places where they might be able to fit in with banks that are willing to take some of this approach to their communities and to expanding their market share. And if you could move on to the next slide, my last substantive one, and I'll be a little quicker after this. I've listed on this slide a few steps that you might want to take to develop a partnership with a bank. I'll pause for a brief moment just to say a few words about a few of the bullet points here, not every one of them. When I'm talking about understanding CRA here on that first bullet point, you're already participating in this webinar, so I think you're taking a good step forward on this score. I hope you participated in the the previous two NDI webinars. Those were excellent introductions to CRA and to developing productive relationships with banks. When I say understand the local market, I mean, think specifically about credit needs, specific credit needs, or community development and financial services needs that your constituencies need. Some of those things that I was talking about on that very first slide about what banks do overall. When I understand local banks, think about the differences between the banks in your communities, the sizes of those banks, their capabilities based on those sizes, the different types of products and services they offer, the conditions and fees they charge for those services. Think more particularly about those things and how well they comport with your constituency's needs. When I say identify your sources of influence, it's my way of suggesting that you consider what business opportunities you might offer to the banks in your community. Do you have information, or do you have connections to groups of people or to institutions in the community that banks don't otherwise have? It's quite possible that you do. If you can give the bank access to potential business opportunities, especially to ones they can't access right now, I think that you stand a great chance of doing productive business with the bank. You also might have relationships with other partners that bankers would find valuable in responding to the needs that you identified in that first step here, and the first step on my first slide. Relationships with other local nonprofits or local government or community development financial institutions and others. My last bullet point here, talk with bankers. In my estimation, that's perhaps the most profound aspect of CRA, and that is that it provides some impetus for bankers and you to converse, to discuss those credit and community development needs and the ways that banks maybe can do a little bit more to meet those. So I'm going to stop there, unless there are some questions. I think we're holding the questions till later. So I'll just stop there and mention that the next few slides that I have here really are resource slides that I think are best seen online after the webinar is over. The links only make sense if you're ready to surf the web for them. So thanks for your time.
Thank you, Paul. Much to think about, and basic orientation that I think builds, as you said, on our prior two webinars. You've got some great links to further information resources that come from both the OCC and from FDIC, and we will make sure that these are added to easy to find on our portion of our website for the News Center. You also have provided information on how people can reach you. I hope you will be hearing from some of the people who've joined us from across the country on this webinar. So before we turn to Paul with questions, we want to turn next to our second presenter, Jessica Farr from the Federal Reserve Bank of Atlanta, who's going to take us deeper for all of us to understand more about CRA exams, how do they work, and the nuts and bolts of examinations from the regulator's perspective. Jessica, thank you for joining us, and let me turn it over to you.
Great. Thank you so much, Michael, and I'm very happy to be able to join you all today. I think I'm going from the opposite, or we're sort of on opposite ends of the spectrum. Paul was very high level, and these are going to be much more technical comments, I guess, about the overall CRA examination process. And I guess one disclaimer I want to make is that this is trying to leverage off of the prior two webinars that were conducted. So I have not gone into great length to explain some of the more technical terms that were covered in the last two webinars. Hopefully, if there is some confusion, you can either raise a hand and we'll try to address those through the panelist questions, or I encourage you to go back and look at the slides, particularly the slides from the first webinar, which really went into detail about some of the components of the CRA examination process that I will touch on today as well. So with that, can we go to the next slide? So I was asked to walk through the process of the CRA examination, sort of from the beginning to the end, how we do it. What do we do before we're at the bank? What do we do when we're at the bank? And what do we do after we leave the bank? And I think as a general statement, it's safe to say that the examination process has changed significantly over time. A lot more work is done remotely and off-site, and not necessarily with spending 3 to 6 weeks or several months at a bank. I know when I first started at the Fed, we heard lots of stories about examiners taking over a town for several months at a time while they were doing an exam. And that is not the case anymore. A lot of what we do these days is done remotely, particularly for the CRA examinations. But before we start an exam, normally, and I have some resources here at the back of my slide deck as well, but examinations are scheduled 3 to 6 months prior to the exam start date. You can actually find out what banks are going to be examined and when up to 2 quarters out on the agency websites. So in advance of that, once the date has been set, we send a letter to the bank that's actually asking them for specific data on their lending activities and on their community development activities, on retail branching, on a lot of different components of the CRA exam that we'll be looking at. That request is sent out to the banks probably a good 4 months prior to the actual start of the examination. So you may hear banks say that they're working on their exams for months on end, and that may be the case because we are requesting a lot of information from them well in advance of the date that the exam actually starts. Before we officially start the exam, we'll do what we call the scope, which is where we outline what we're going to look at and what exam procedures we're going to be using to evaluate the bank. So as you learned in the first couple of webinars, we have different exam procedures for banks depending on their size and business strategy. And for a small bank, we have lending. We only look at lending activity.
Jessica, I think you might have lost your audio. One moment, please, everyone. Oh boy. Okay. We'll give Jessica a moment. It looks like the audio might have dropped off the call. So while we wait for her to reconnect.
Do we know if we have others on?
Okay, we just need to get Jessica's audio to reconnect, but why don't we go ahead and ask, I believe you had some questions for Paul that we were going to do at the end, but let's go ahead and ask Paul some of those questions now. That works, and we'll wait to see if Jessica is able to rejoin through the audio.
Sure.
So, do you want to take those away?
Janet, I think the first question is for you.
Yes. Thank you so much, Paul, for your presentation. It was really helpful. Could you explain a little bit more about the ratings that are assigned, the outstanding, satisfactory, all that? If a bank gets less than an outstanding rating, what opportunities are there to have community groups seek a new level of investment lending and service? In other words, we encourage community groups to go to the FFIEC website and look at the public report. But if they see a financial institution in their community that has a satisfactory, how could they go about engaging with that financial institution to assist them and partner with them to aspire to an outstanding evaluation for the next exam?
Well, you know, I usually think of, I'm going to lead right off of what I was saying in my slides, and I usually think that one of the best ways to talk with a banker really is just about their business self-interest. And what is it that you provide that will get them more customers, or perhaps help them acquire more customers at lower cost than they would just on their own? Or what information or insights can you give them on the needs, the locations, and other particulars of customers that they currently aren't serving? Or how is it that you can help those potential customers become good borrowing customers of the bank, for instance, by preparing them for being good borrowers, so that the bank doesn't go through all of the education of the borrower, potential customers, potential borrowing customers, as they might otherwise have to. Or what other kinds of partnerships can you bring to the table that would help the bank do business? So even though the bank has a satisfactory rating, I think there's a good appeal to the side of them that really is concerned with running their business in a good way. And there's something else I do want to mention about those CRA ratings, especially with the larger banks, the ones that do business in a number of states. They'll often have, well, they will in fact be rated separately by metropolitan area and by state. So even though they may overall have a satisfactory rating, if you dig into their exams, and I know that in some of the OCC exams you can find a table that will show the ratings for all of the assessment areas where we've rendered a rating. And you'll find that some of those maybe are less than satisfactory. And so they can, even though their overall rating is satisfactory, even outstanding, they'll have some places where they need to make some improvements, or there may be some places where they just want to make some improvements. If you see some things that aren't outstanding where everything else is, so maybe it just shows up as satisfactory, but most of the bank's assessment areas are graded outstanding, those may be some places where you might have a better receptive bank, and certainly where there are a needs to improve rating on some of those smaller geographies rather than the institution overall.
Thank you. That's really helpful.
Thanks, Janet. This is back to Michael and Paul. Most banks, it appears from reviewing performance reviews, are receiving satisfactory ratings, and better over 90% are. Given banks are getting these high ratings, what do you think would be the most effective strategies to encourage banks to do more with disability-inclusive community development? Well, I'm going to have to go back to that the bankers' self-interest in their business and finding them your ability to help them do business with a group of people that perhaps they're not serving as well as you might like them to. I really think that that's probably your strongest case for getting to those banks, for doing business with those banks that are already rated satisfactory. Now, just because a bank is satisfactory or has been rated satisfactory, you know, that's done by examiners looking backward over the past several years of the bank's performance. And I think bankers feel a lot of pressure to continue to maintain a satisfactory rating. There are a couple of, I'll say, penalties that they suffer if their rating falls below satisfactory. So even though they're satisfactory today, they might not be the next time around. And they're very concerned about that, and they want to maintain at least that satisfactory rating because they want to have an easier time having applications that they make to us to expand their operations, either by buying another bank. Hello?
Yeah, I think your audio might be cutting in and out a little bit.
Mine?
Yeah, it sounded like it might be cutting in and out a little bit, and I'm sorry to interrupt you. I just wanted to check to see Jessica.
I am back on. I don't know what happened. I was talking and the phone was still on and you were gone.
Jessica, let's go back to you. Paul will come back to the questions in a few minutes, but let's go back to Jessica and her presentation.
Yeah.
So sorry, that was very strange. I don't know where I lost you. Did I get through this whole slide? I did in my own slide deck, but I don't know.
You're on the slide. You began with examination scoping and going next to review of banks' assessment areas.
Okay. So really quickly, because I don't want to take away from the time for the questions, one of the other key components that we work on before we actually start the exam is developing the bank's performance context, which is the review of social and economic factors, or as I like to say, the internal and the external factors that can impact a bank's ability to do lending, investments, and services in a assessment area. And this relies on both publicly available data sources as well as review of reports and other types of information. We do a preliminary review of a bank's lending and community development activities. We conduct community contacts, and again, we try to structure those community contacts to align with the type of bank that we're going to be examining. So if we're looking at a bank that's primarily a mortgage lender, we're going to try to talk to contacts that deal more in the home ownership space or in the housing space. And if we are looking at a bank that's more of a small business lender, we'll talk to those that are focused on economic development. And we also talk to contacts that can give us a good general understanding of what opportunities and needs look like for low to moderate income consumers overall. And then the final step is reviewing any consumer complaints that have been submitted with the examination. Can we go to the next slide? Am I still on okay?
Yes, you sound
okay. So when we actually get to the bank, what do? Well, one of the first steps is we look at, and we do this for banks of all sizes, whether they're small banks, intermediate small banks, or large banks, we consider their lending performance. And one of the first things that we look at is whether or not the bank is lending in those assessment areas. And we look at that looking at both the loan-to-deposit ratio, what the bank's loan-to-deposit ratio is an indication of whether they're making loans with the deposits that they're taking into those markets. We also look at how well the bank is lending inside and outside of their assessment areas. So are they meeting the credit needs of their assessment area? And finally, we look at a distribution of the bank's loans by geography and borrower income. And we look at these both comparing to a demographic comparator and also to the aggregate, so to what all other lenders in that market are doing. We assess the bank's community development activities, and we consider both quantitative and qualitative aspects of the bank's activities. So we're not just considering the volume of what a bank is doing, but we're also focusing in on the qualitative aspects of those activities. So how well what the bank is doing is meeting needs that we've uncovered through the review of the performance context or in talking to community contacts. We're looking at what the bank is doing to see if they're meeting those needs and if they have addressed opportunities that exist within their assessment area. And I just wanted to highlight this because I think it's really important to understand that a dollar investment is not the same. Every dollar of investment is not treated the same. We do consider these qualitative factors as well. For large banks, for those, again, over the 1.2 billion threshold, we're also going to be looking at the bank's branching and the types of retail services that they're delivering, including alternative delivery systems that they may be delivering outside of the typical branching network. When we're on site at the bank, we use that time to really talk with management about their CRA strategy, to learn more about the types of programs that they're doing, what they've identified as the needs in their community, and how they think their CRA program are addressing those needs. We also talk to them about performance gaps and what their strategy is for addressing some of those gaps. Can we go to the next step? So in the final piece, and I apologize, this is a very abbreviated version, but the final steps once we have completed the time on site and had a chance to review all of our analysis, we present preliminary findings and identify any identified concerns to bank management. We have a chance to talk about that. We don't necessarily, and we'll take into consideration if there are certain things that we've overlooked or that bank management feels are important for us to note in regards to our analysis. We then prepare the final performance evaluation, and we submit that for review. And again, this process for review varies significantly by the different agencies in terms of who is responsible for doing the final performance evaluation review. And then once the performance evaluation is finalized and we've given it to the bank has 30 days to do one last review, and if they accept it, then they are required to place it within their public file within 30 days. But that 30-day window also gives them an opportunity if they have a material dispute with something that we have in the report, that's their window to appeal the final PE before the PE before it's finalized. Can we go to the next slide? So how can the public engage in CRA exams? I think this is a question that we get frequently. And I think one of the most important things is just to know where you can find when CRA examinations are scheduled and what banks are up for examination and when. You can find this on each of the regulatory agency websites. And I think, at least on the Federal Reserve, I think we go out at least 2 quarters, so you'll see exactly what banks are going to be examined and when. And it also gives you an opportunity to submit public comments about those banks. And I know, at least on the Federal Reserve website, you can submit a comment specific to a bank right from the Federal Reserve Board's website. Comments can be submitted in conjunction with an exam, but they can also be submitted outside of the exam process. So if there's concerns about what a bank is doing, it is possible to submit comments that will not be directly tied just to the examination. But I also think it's really important to remember that not all comments have to be bad. So if a bank is doing something well and you want that to be recognized, it's also a good opportunity to submit comments.
Yeah.
There are also opportunities. It's also important for the public to know about the CRA public file. Anybody can go in and request the bank's CRA public file, where you can get a copy of their most recent performance evaluation. You can find out about any complaints that the bank and how the bank has responded to those complaints. You can find a list of the bank's services and branches and their assessment areas. So there's a lot of information within the public file that the bank is required to disclose to anyone who comes and would like to see it.
Just hit end.
Another good opportunity for the public to engage is in contacts. We do like to have some diversity, and I know this is a question, but in terms of thinking about ways to get the needs in the disability community more widely recognized in the CRA evaluation process, helping us understand who good community contacts are is a very viable strategy, so that we know more about the types of can help broaden and diversify the types of organizations that we're reaching out to. And then know how to go and access the CRA public evaluations that are out there. We strongly encourage people, when you're interested in learning more about what a bank is doing, to make sure you pull their public evaluation, but also make sure you pull evaluations for other banks in those, so you can have a better feel for the range of activities that different banks.
I'm taking the call in his office.
Can we go to the final slide? So what else can community stakeholders do to engage in this examination process? The performance context is a key area. I think it's important for examiners and bankers to better understand the different community development and credit needs in the market, including what kind of product needs there are and where there are any gaps. And it's really helpful for banks if community groups can work with them to help them tell their story. So again, in helping them specifically talk about what the needs are in the disability community, and if the bank is doing anything in particular to help meet those needs, helping them craft that story that they can incorporate into the performance context is extremely helpful for both the bank and for the examiner when we go in to do the exam. And then always making sure that when you're working with a bank that you're providing them with the appropriate supporting documentation. We're going to ask the bank, how did you decide that this activity that you've submitted to us is a qualified community development activity? And they need to have the documentation in hand to show that. So if there's is a great opportunity to make sure that the bank is well equipped with any data that will help them with being able to answer that question for us. And then secondarily, being able to help the bank tell us what the impact is of that activity. So again, if there's data, if there's anecdotal stories, things like that, that can really help demonstrate what the impact of the activity is. Those are the kinds of questions that we're going to ask the bank, and the more information that can be provided by community partners to the banks will only strengthen our evaluation of the bank's performance. And I think that is my final slide. Yes.
All right, folks, hopefully you can hear us. We apologize. We've been having an array of technical difficulties here in our conference room. I'm going to turn it over to Mark right now. Go ahead, Mark.
Great. In the interest of time, let me speed this forward. So this question is for our guests. So there are the three federal agencies, the FDIC, the OCC, Office of Control of the Currency, and the Fed. These three regulators have responsibilities for CRA evaluation, among other things. Could you both talk very briefly about what major similarities there are in terms of how those three federal regulators handle their responsibilities? What are the sort of crossovers, the principal crossovers? But then perhaps more importantly, what differences are there? Obviously, each of those three regulators has a different pool of banks over which they have responsibility, but talk a little bit about the differences or the approach or the rules that are perhaps unique to each of those three regulators, if you would.
Well, Jessica, do you want that one, or
You start, and I will add to it.
Okay, I'll just start with that. CRA is the same among the three agencies. We've taken deliberate steps over a number of years to keep it that way. And that's been done primarily through the questions and answers on CRA, which I'm not sure if everybody in the audience would be familiar with those. So I'll very briefly explain that there's the statute, the law, CRA, the Community Reinvestment Act. And then once Congress passed that, it has been up to the regulators to write a regulation that implements that law, that explains how we're actually going to apply it in banks. And then thirdly, as I mentioned, the questions and answers on CRA that explain a little more particularly what we mean by the regulation. The regulation is the same one across all three agencies. The questions and answers also are the same ones across the three agencies. I'm sure that there are some policy differences between us. The frequency of exams at large banks, those are over $250 million in total assets. But I think the real differences rely primarily in the banks that we regulate. I usually think of the OCC as regulating many of the largest banks in the country, not all of them, but many of them. In this category, I'm thinking of JP Morgan Chase or Bank of America, for instance. But we also supervise more than 1,000 community banks across the country. Just think about First National Bank of your hometown. Though I would note that the FDIC regulates many more community banks than the OCC does. So if there's somebody that really has a big share of that market, it's the FDIC. So Jessica, I'm sure I haven't covered it all.
No, I think you did. I don't think there are, I think when it came down to what's the actual exam procedure and who is responsible for doing what level of review and how that kind of information, how that process works, it probably varies. I know it varies within Reserve Bank to Reserve Bank, so it obviously probably varies across agencies. But I think the substantive work of, is the same. And I think that it's been very important to us to try to keep it consistent across the agencies.
But we are human beings, and so naturally there's going to be some variation here or there.
Thank you so much. I appreciate that. This next question is about the CRA performance evaluation itself. Which elements of that CRA evaluation require the most time? Which ones are require the most quantitative information or are the most data rich, that demand the most sort of rigor, if you will? Talk a little bit about that. How much of your time do you spend in various aspects of the CRA eval itself?
I'll start with that. This is Jessica. So in terms of what's, you said data rich, I would say the most data rich component is the lending analysis. And for anybody who's tried to understand a bank's performance under CRA, the best source of data that you're going to find out there is on the bank's HMDA, for large banks, that is the bank's HMDA and CRA lending volume. And so we're much more limited, and it's much more varied in terms of the type of data you're going to see around a bank's community development loans and investments and services. They're not, at this point, required to collect community development, investment, and service data. So whatever we have is whatever you see written within the performance evaluation, whereas anybody can go and pull HMDA and CRA loan data. The lending analysis is definitely, I think, the more straightforward. We have identified comparators that we all use, so we assess banks' lending relative to to a demographic comparator or to an aggregate comparator. For community development activities, a lot more data is required and a lot more is asked of the banks in terms of what they submit to us and describing what those activities look like. And I would say that is more challenging and some would say subjective in our analysis. We have to first determine if we agree with the bank that an activity actually does qualify under one of the buckets of community development, being affordable housing, community services for low to moderate income individuals, economic development, or revitalization and stabilization. And then once we've done a review to determine if we agree that these activities qualify, we then have to answer the question that bankers are always asking us, which is how much is enough? We do not have at this time standard comparators that say here are our expectations based on the bank's deposits or on the number of branches or anything like that to say, these are the set expectations that a bank is going to have for lending, investments, or services in these markets. So we need a lot more data when it comes to the community development side. We're also looking at the qualitative side too. So again, we're looking at whether an activity is considered more responsive or higher impact or innovative or complex. So we're seeking data from the bank to help justify or help determine whether a loan meets some of these additional qualitative factors. So I think that's probably where I will leave it for now. Paul, is there anything you would want to add to that?
No, I think you covered that one just fine. I will, however, comment very briefly that community development side of exams really does absorb a lot of exam time and attention. Just trying to first decide what actually belongs in the community development bucket, and then, like you say, trying to assess it without clear comparators.
Actually, I will add to this. I talked about the other key test that we look at is retail services, and assessing retail services can be somewhat straightforward. And when we're looking at the bank's branching distribution, so how many branches are in low, moderate, or middle or upper income tracts. But it gets much harder for us in understanding how the bank may be delivering services outside of the branches that meet the needs or effectively meeting the needs of low to moderate income consumers. And that's an area that we're continuing to discuss in terms of how we can provide better guidance, how we can what kind of data is needed to evaluate how well the bank's retail services are meeting the needs of low to moderate income individuals. But as the distribution of financial services is changing so rapidly and the way people are conducting their financial business is changing so rapidly, I'd say retail services is an area where we spend a fair amount of time.
Hi, let me try again, Jessica and Paul. If you're a community group and you're working with low to moderate income individuals, what would you say, from a bank regulator standpoint, what type of comments would be most insightful to you in terms of commenting on a bank's performance?
Jessica, you want to go with that one?
Sure. So I think that it's really helpful for us to know, when the comments are submitted, kind of what the commenter sees as the needs and the opportunities in their market, and then some detailed kind of discussion points about what banks are doing or not doing to meet those needs. So I think what's really helpful for us is if it's specific. It can be very challenging for us if we hear banks aren't doing any lending in low to moderate income areas anywhere in my city. We need something that's more specific and that can actually help us drill down and say, maybe there are some reasons for this, or what kind of data should we be looking at to evaluate the strength of this comment. I mean, we take any comment that's submitted very seriously, but then we have to explore it to figure out, if there's something really valid there that we need to dig into further. And so the more specific commenters can be, I think, the better. Paul, you want to add anything there?
I guess, I do have an example that I could talk about of a case where I've done a couple of community contacts and how that had a direct connection to what I suggested to the examiner in charge should be the rating of the bank on their community development activity. Michael, do we have a little bit it's going to take me a minute or two to go through this, maybe more than a minute or two. Is that okay?
Oh, yes, absolutely. I think that'd be very worthwhile.
Okay, I'll begin just by saying that I think Jessica's right on when she talks about wanting to know more about needs and opportunities just in general. If you think about what a bank examiner is charged with, they're responsible for making an assessment of a bank's performance relative to the needs and opportunities in low and moderate income communities. And they aren't necessarily from the locale where the bank is, so they have to bone up as quickly as they can and as thoroughly as they can before they get to the bank, so they have some suitable background to measure the bank's performance against. And I'll just go through this little story that I've got and hope that may illustrate a few of these things. And I should say one of the things that examiners do, Jessica has mentioned a few times, community contacts. We make deliberate efforts. Examiners go off for every exam and either talk for that exam to organizations in the community where the bank is doing business to ask them what they are aware of as needs and opportunities in that community, and to hear from those same individuals who we presume, because they're on the ground, will know a good deal about what's going on in the community, to hear from them which banks are doing what kinds of things in the community. and which ones seem to be making some good efforts to meet local needs. So a few years ago, I was on a CRA exam at a bank that served a few predominantly rural counties that had a few smaller cities in them, but those three cities were large enough to be entitlement communities. So they got HUD, Community Development Block Grant, and home money and things of that kind. And two of those cities were particularly hard hit. They were Rust Belt towns. They were hard hit by deindustrialization, by the Great Recession, and so on. The other one was a university town that it was going along pretty well. The bank president kicked off the exam by telling us that while the bank had really been a home mortgage lender since their founding, they had been aiming to be the business lender in the communities they were in. And he told us that he was hoping for an outstanding rating. In the course of the exam, I was looking at the bank's community development activities. I did a couple of things. I interviewed the director of the local public housing authority in one of those Rust Belt communities that I mentioned. And he told me that housing rehab was a key need in the area. In fact, he told me that this housing authority was chartered to serve the city, that small Rust Belt city, but in fact, most of the housing vouchers they distributed were being used out in the larger county, which was largely rural. And that's because people couldn't find housing in the city that actually met HUD standards. So there was a great need, he told me, for housing rehab. I should say, on my own, I located an article in the local press about that practice of the housing authority. I also interviewed a regional economic development organization that served the counties that they served a bunch of counties that included the ones that the bank was serving. They had a regional economic development plan. They managed several loan pools, some of their own, some for other jurisdictions, counties and cities and so on. And they told me that they were looking for loan committee members, especially for bankers, people who would be good at making credit decisions for these loan pools. They also told me that job training was a key need in the area. And then on my own, I identified that there were a few small business development centers and a SCORE chapter that was active in the counties where the bank does business. Among the bank's loan offerings were home mortgages and small business loans, but not home improvement loans. They also they listed no donations among the activities that I was looking at, no donations to the Regional Economic Development Organization, no donations to the SBDCs, none to the SCORE chapter. And even though they gave me a lot of community development service, that is their volunteer activities, none of them were with any of those small business organizations. So at that point in this exam, I was definitely hard-pressed to find a way to an outstanding rating. I'll just leave it at that, except that I'll add on that the bank ultimately, that I did suggest to the examiner that at least that a satisfactory rating might be appropriate. And that was really based on a few things. The bank did do a number of important things. This was early 2014 that we were reviewing the bank's activities, and we were looking back over a period where the region that the bank was operating in had been undergone a lot of flooding. They were suffering from very poor economic conditions. They had very high unemployment rates, well above the state average. And on top of that, the state had significant budget problems for a number of years, and so they had slashed nonprofit funding, especially for social service agencies. And in response to some of that, the bank had substantially increased. They hadn't quite doubled, but it was on that order of magnitude. They had really substantially increased their donations during the exam period. And besides that, many of the bank's donations, the cash donations, were several substantial ones, along with large amounts of volunteer time to a couple of local job training organizations. So even though I found them falling short on a couple of key needs that people had expressed to me, they had responded to a couple of other key needs that I was aware of. In addition, they had invested long ago in a small loan pool for small business lending in one of those that was really serving just one of those Rust Belt towns. And then they had drawn on that loan pool to make a loan to a group of investors who bought a failed company that brought back 20 jobs that had been lost. And so it's this kind of weighing process that you go through when you're doing one of these exams. So I'll stop the story, but I will say that, you know, one key thing, if a disability organization, somebody from the disability community, were to come to us and say, if they approach me on the phone or by email and say, I want to talk to you about credit needs and community development needs in the community that I serve, I guarantee you're going to get some sort of interview with somebody from one of these agencies. So it typically is going to be an examiner, but it might also be some of the more management people in our organizations. I've organized those kinds of meetings any number of times. So I'll stop there. I think I've gone on longer than I should have.
Great, thanks, Paul. And you queued up the next question nicely, which is if you could talk a little bit about what makes an investment by a bank qualified for CRA credit specifically. That it's one thing to talk about banks' particular activities, and perhaps banks are doing good things, but what specifics about a particular investment make it CRA worthy, if you will?
I can start with that. So for an investment, and under CRA, an investment refers to an investment that earns a financial return, so low-income housing tax credits, mortgage-backed securities, new market tax credit investments. Those are some of the common investments that we see. And then also contributions. So those all fall into that broader bucket of investments under CRA. The main thing that we're looking for is whether or not that activity meets the primary purpose of one of those four buckets of community development: affordable housing, economic development, community services for low to moderate income people, and revitalization and stabilization of low to moderate income geographies or distressed, underserved middle income geographies or disaster areas. And what we need to see is that piece that it has a primary purpose, which means that the majority of the beneficiaries of the organization that's receiving the investment or of the project that will be funded by the investment, the majority of the beneficiaries either need to be low to moderate income individuals or small businesses or low to moderate income geographies. So those are the main things that we need to see. We do not have a lot of proxies that we use for determining income. The main things that we use are so if we're looking at activities with schools, we're looking at people who are eligible for free and reduced price lunch. We also use Medicaid recipients as one of the income proxies. So if an organization can show us that more than 51% of the clients served were eligible for Medicaid, that is one of the proxies that we can use to show that that investment actually has a primary purpose of that would qualify under CRA.
Great. This next question I'll throw out to both of you, and so it follows up again nicely. Let's say you have an investment or a project is $100,000. Just because you reach a certain dollar amount, that may not be the end of the story. In fact, Paul, I think you made the point that not every dollar is equivalent. If there are, in fact, qualitative analyses that go into assessing how banks are doing, what are some of those qualitative analyses, and where do you go to try to sort of standardize those or make those qualitative analyses objective in some fashion?
I will start there, and then, Paul, I'll turn it back to you to fill in. But we do certainly consider the quality of those activities. I think, as I said during my presentation, $1 is, we don't look at every dollar equally. So we always tell our banks it's quantity and quality. The key qualitative factors that we're looking at is whether the activity is responsive or innovative or complex. And personally, I focus mostly on responsiveness because I think that's easier to measure, and we do not see a lot of innovation these days. Complexity is certainly one, especially when you're talking about community development lending and projects that require multiple financing sources. Those can be very complex, and is definitely the kind of thing that we ask the bank to highlight so that we can give them, quote, credit for having a more complex transaction. Our assessment of these qualitative factors is typically tied to the performance context, but it's also tied to what the bank is able to tell us. So, it's in the description the bank provides to us about that activity, what kind of data they showed that they can provide to us that shows the impact of that activity. And again, I think as I mentioned earlier, this is a really good opportunity for community stakeholders to help with providing some of that information to the banker so that they're in a better position when Paul goes in to conduct a community contact or when Paul goes in to talk to management. He can, you have good data on hand to say, this is not just a $5,000 donation, but this $5,000 donation did this for this nonprofit organization, which allowed them to go on and do this. Or this $100,000 donation helped us create 5 additional affordable housing units that, without this gap financing would not have been available otherwise. So I think the more detail that can be provided by the bank and in turn by their community partners about the impact of those activities, the better. I think what you are not hearing is that we have consistent measurement, and I think this is when we talk about CRA modernization, one of the main things that we're trying to figure out is, are there ways to be more consistent and systematic in measuring impact? And that is definitely a challenge going forward. Paul, do you want to add to that?
We still have Paul.
I'll go forward. Maybe we've lost Paul for a moment.
I just got back.
Good.
Not sure what's happening here. My turn. That is to get shut out.
Paul,
I finished the question, and I didn't know, and I talked about the fact that we rely heavily on the banks and community partners to share with us how to define whether or not activities are more impactful. But if you have any other things that you would like to add to that question, that's where we were.
Yeah, right off the top of my head, I'm just going to leave it at that, what Jessica said.
Okay.
All right, then I'll go back to Paul. There are some, there have been many bank mergers over the years. There are some pending. If you're an individual or an organization that wants to communicate with bank regulators about concerns on reduced physical presence or potential loss of services, what's the best way to go about that?
Hold on just a second. I wanted to locate some notes that I made on that. What do you remember what number that was, Michael? I'm sorry.
For 14.
14, thank you. Right. Yeah. So there are public comment periods for banks' applications to us for things like mergers. So the first thing you need to bear in mind is you need to make comments within that period. It's usually, I'll say it's 30 days. I think that may vary a bit by application. I don't think by the agency. And the real trick, I would say, is keeping track of which banks have filed applications with which regulatory agency, and better than keeping track of the closing date for the comment period. You can always, there are, I don't know precisely the procedures right off the top of my head to whom you should direct the comments. You can certainly call any of the community affairs people at the agency, and they will be able to get you the right information on just where you should direct your comments. I would say that if it comes to branch closings, there are some very specific procedures that banks have to follow when they're closing a branch, including public notice 90 days in advance of the closing. And in that notice, they will include the address where you can direct comments about the impact of the closing. I would say one good source that you might consult in connection with the branch closings is the OCC's, at least in terms of the OCC and making comments to us, is licensing manual. So if you were to Google OCC licensing manual, you'll come up with a PDF version online. And it should be very easy to find in there the information that you'd be looking for. One other thing I'll mention is something known as Waters meetings, or known informally as that. These are meetings that the public is able to request the agency's, the primary regulator of a bank that is an interstate bank that has closed a branch in a low and moderate income community. And those are very specific terms that have particular definitions that the interstate bank and those kinds of things. But if there's a branch closing that has this public comment period attached to it, after the branch is closed, these Waters meetings accept the branch closing as it is. It's a business decision of the bank. But the agencies can be involved in helping a community locate other ways of meeting their needs for financial services. And so we can convene a meeting that would bring a variety of players together on the local scene to talk about what might be done in lieu of that particular branch. And I know in some cases there have been others that have stepped in to provide the services in that branch or perhaps in another one nearby that provides a good level of service. So I'll stop there. I don't know if any of that's helpful. I hope it is.
Yes, I think it is. I'm going to try to go to the chat box and we see if we can get some short answers to a bunch of questions. First one is, can you talk about residential bank accounts, not just lending? How can banks get credit, or would they get credit for low cost, no overdraft checking?
So,
Jessica, you want that one?
I'll start on that one. So we do consider the products and services that the bank offers under the retail services test. And we also consider if the bank offers innovative or flexible lending products when we're just evaluating their lending performance overall. As of right now, there really is not a component where we look in great detail at the different types of consumer products that are offered under CRA and evaluating how the take-up rate for those among low to moderate income consumers. I think that we do have a component that looks at consumer loans overall, and some banks have the option of reporting consumer loans for us to consider, but I think that's more the exception than the norm. And if it's consumer, it's all kinds of consumer. It's not just going to be your basic action account.
Yeah, let me go to another quick question because there are several here. We're somewhat new to all this, part of the disability community. We help people with disabilities get jobs. Are there some examples of how CRA can touch the disability community, let's say related to employment or workforce development?
You want to take that, Paul?
Sure, I'll start it off. Short answer is yes. There's seriously the economic development component of the community development test contains, we can consider under that component workforce development. And I'll say that the agencies lately have put a good deal of effort into informing the industry about opportunities and partnerships The Federal Reserve banks in particular, I should single out. A few of them in particular have put out some outstanding publications on this. And so the idea that they've done is try to inform the industry of what opportunities are out there. But of course, that also is helpful to examiners in terms of thinking through what the bank has done and what consideration they can give it.
Let me break in again just because I want to get to more questions for one of you to answer. Good question. Is there a list somewhere on any of the regulators' websites of what are qualified activities, and is there any way that they're classified high impact, low impact, anything like that?
The short answer is no, and that is unfortunately why it's important to go and review performance evaluations to see what's been highlighted in the performance evaluations. Paul, I don't know, do you guys still have the OCC's Public Welfare Investment Directory? I think you do, right?
We publish quarterly a list of the public welfare investments that banks have made.
But that doesn't have anything more. There's no qualitative discussion to that about whether it's considered high impact or.
Right. There's nowhere that we make that kind of distinction between these activities. I would suggest that there are a couple of lists in the questions and answers on CRA that I mentioned before. We have examples of community development activities of different kinds. You might find those helpful. So it doesn't name specific organizations, but I think it describes pretty clearly the kinds of activities that we would be considering under those categories. Okay,
I think there are other questions. We'll try to send those on to both of you, and maybe you can help us with answers that we can then post on our site. I want to quickly go to a few other points of information. The new center has created an advisory work group. It's going to have its first meeting at the end of this week. It involves leaders from both the disability and the financial community, and we'll be talking with you more about that. It will be led by Janet Hamer, who formerly with the Federal Reserve Bank of Atlanta, and Tom Stokes, former regional manager with the FDIC. We'll talk more about this in future webinars. Want to bring to you information about next month's webinar, which is going to specifically focus on workforce development and meeting obligations under CRA. We will have Stephen Shelpowicz, Senior Community Development Advisor, Federal Reserve Bank of Kansas City, Oklahoma City branch, and he will have with him as co-panelists representatives of both an example of a bank and a community group who have benefited from CRA support in this workforce development area. I want to thank you both. Sorry to our audience for some of the technical difficulties we had today. We will try to send some of your additional questions on to our panelists and seek answers that we can then post. But please stay in touch with us. Join us next month for a new webinar as we focus on workforce development and CRA. Please do visit our website for the Center for Disability Inclusive Community Development. And I appreciate all of your interest in trying to really decipher, for those of us in the disability community, an entirely new landscape, but a very important one, with really great opportunities for collaboration and partnership between banks in local communities and local community groups. I hope along with us, you will continue to learn and benefit from these webinars. Usually takes a few weeks, but we will post the slides and the webinar itself. And so it's something you can look back on. My apologies to some of you. We didn't get to your questions. Hopefully, with our panelists, we can get some additional answers and then post those on the website. So thank you again for joining us. Stay with us, I hope, and be a part of this effort to improve the work across the country in terms of inclusive community development as it impacts low-income individuals with disabilities in the footprints of banks nationwide. Thanks again and have a great afternoon. Take care.